Your phone lights up. It's an alert from your banking app, letting you know your credit score just went up by 10 points. It comes with a bright green arrow and an undeniable hit of dopamine. We are conditioned to see that 3-digit number as a definitive report card for our financial lives, proof of responsibility, success, or even wealth. But the algorithm calculating that score has a massive blind spot. FICO completely ignores your income. It factors in zero data from your savings account, your retirement fund, or the assets you own outright. To the formula, a millionaire with zero debt and a completely broke citizen with zero debt look exactly the same. They both get a blank slate. That happens because the FICO score, introduced in 1989, was designed for lenders. It was built to standardize risk assessment across the industry, not to track your personal financial health. The number on your screen is a highly engineered behavioral metric. It tracks exactly one thing: how profitably you can be farmed for interest. To see how this system operates, we have to reverse engineer the math behind the score and look at the specific behaviors it rewards. This pie chart breaks down the FICO formula. The 30% debt burden slice reflects your utilization ratio, debt divided by extended credit. To boost your score, the system encourages acquiring higher credit limits. Another 10% rewards managing a varied mix of debt simultaneously. Lenders willingly extend this extra credit because they understand human psychology. They know that expanding your limits and encouraging multiple accounts increases the statistical odds that you will eventually carry an interest-bearing balance. The rules of this game mathematically reward the exact behaviors that maximize a bank's long-term revenue. In this system, your financial independence is secondary to your utility as an interest-generating asset. But the banks are just the players on the other side of the table. The actual architects of this system are 3 massive data brokers. One is Equifax, another is TransUnion, and finally Experian. These bureaus aggressively market their own gamified score monitoring apps directly to consumers. They profit by selling your data to banks, then turn around and upsell you subscriptions to manage the very anxiety their data creates. The Consumer Financial Protection Bureau recently fined major bureaus tens of millions of dollars for deliberately deceiving consumers and trapping them in recurring fees for these trial services. It is a closed, cynical loop. The scorekeepers directly monetize the psychological stress of the players. So, what happens if you refuse to play? What if you balance your budget perfectly, pay for everything in cash, and avoid borrowing money entirely? You become a credit invisible. Millions of Americans exist in this category, algorithmically erased from the financial system simply because they lack a history of debt. Living without a score carries severe, real-world punishments. You face automatic denial for apartment rentals, locked out of the mortgage market, and you can even be disqualified from certain employment opportunities. The system punishes absolute financial independence with algorithmic exile. To participate in modern society, acquiring debt is a mandatory condition. Viewed at scale, the American credit score infrastructure is a mandatory social credit system for capitalism. It is an inescapable behavioral management tool. The constant pings, apps, and alerts are behavioral management tools. They exist to guarantee voluntary compliance with a debt-driven economy. That congratulatory notification pushing your score up into the green is the ultimate psychological trick. Next time your phone congratulates you on a higher score, remember you aren't the player winning the game. You are the product being farmed.